Thanks a lot. So it's a great honor to be here. It was a wonderful, interesting day. It was a long day. So I knew I would be tired, so I pre-recorded my remarks. I'm going to be lip syncing. All right. No, actually, I feel good because for me, like spending half an hour seeing Ricardo talk about like 10 papers with 100 slides makes me feel like I'm in graduate school again. So I feel young. All right. Okay, so international financial crisis. An international financial crisis is a combination of a variety of things happening at the same time. There is a kind of a capital flight dimension. There is currency movements. There is a banking crisis. There is the domestic recession dimension of it. So emerging economies have experienced financial crisis often, and in many ways have provided kind of a crucial lab for thinking about financial instability, even at the times of the Great Moderation. And that is actually a reason why international economists were probably less surprised than the average economist when the global financial crisis happened. And for sure, Carmen and Ricardo are definitely two people that when the crisis started were a little less kind of deer in the headlight situation. They had already a framework for thinking about what was happening. And Ken mentioned the fact that their findings came out at a very timely moment and provided very useful input to think about policies. They took the two people I'm going to discuss have the same initials inverted, RC and CR, and but other than that, I'm going to look for commonalities. This is going to be a way of organizing my talk. But of course, in terms of approaches, they're very different. So Ricardo's been working on building models to kind of build insight and capture fundamental forces in the economy, while Carmen has been working and kind of to find regularities in the data, to find patterns in the data that we see repeating themselves regularly. So I look for common themes. The first common theme is very easy in a sense, and there's the centrality of credit markets for understanding international financial crisis. Now many of us maybe take that as a given, but the truth is that in the 90s, when they started working, the standard way of thinking about international financial crisis was focused mostly on unsustainable fiscal policies or non-credible monetary policies, and so-called first generation and second generation models of currency crisis were all focused on that dimension. So now kind of it's easy with the benefit of insight to underestimate how much effort went into just focusing our attention squarely on the working on credit markets and really realizing how important was the banking dimension, the financial dimension, and the capital flight dimension for economies with an open capital account. In particular, the work of Carmen with Graciela Kaminsky introduced us to this notion of a twin crisis that emphasized like the fact that currency crises happen often at the same time with dislocations in the financial sector, with banking crisis, and that financial liberalizations and credit booms are often precede the crisis and set the stage for the crisis. And the work of Ricardo with Arvind in the early 2000s, I cite 3 papers, but there is more, and Ricardo covered some of them. But again, the central theme of those papers was an emphasis on bringing like kind of macro financial tools into thinking about open economies and understanding the issues that arise in open economies, in which the ability to borrow domestically is not the same as the ability to borrow from abroad, and some firms have access to finance from abroad, some haven't, some don't, and how when a crisis happens, the funds shifts inside the domestic economy. One contribution that I'm going to just point out is they started thinking about also the welfare implications, because there is an important question when you think about these topics, and this, like all the topics that we discussed today, is are we looking at something that is kind of socially inefficient? Like we see a build-up in credit, and of course the build-up in credit also has good sides and not only bad sides, and so is that inefficient? And the work that Ricardo and Arvin did was among the first to kind of use the notion of pecuniary externalities to understand what are the inefficiencies that can arise. And I benefit directly because in my own work I've followed that path, and then there's been a large literature following thinking about optimal policy from the perspective of addressing this type of inefficiencies. There is a second common theme that I also want to emphasize, and the second common theme is that both authors have pointed to the fact that to understand financial crisis is not enough to kind of take the so-called small open economy view of the world, in which we kind of like assume that the rest of the world works perfectly, and then there is international investors that are kind of perfectly elastically supplying funds to this economy. But we actually need to take a global view. So we need to put this crisis in the context of a global financial system where imperfections are everywhere, not just local. Okay, it's the end of the day. We're tired, so I thought it's not time for a model, it's not time for a graph, it's time for a story. So I'm going to tell you a story and then put you to sleep. So this is a story of US providing safe assets to the rest of the world. And then the East Asian crisis happens in the late 90s. And then several emerging economies realize that they're exposed to this risk. And because they realize that they need to accumulate a buffer of safe assets, including accumulation of official reserves. That tends to push interest rates in the world down. That means that then the US financial sector has incentives to produce safe assets, even by kind of packaging stuff and trying to produce something that looks like AAA. And then at some point, some shock happens, and we realize that not all of that was really AAA. And so that sets the stage for the 2007-2008 crisis. And then the supply of safe assets shrinks. And so then interest rates were already going down. They go to zero, and we find ourselves in a global liquidity trap. And then things normalize slowly, but these original tensions are still present. So this is a story that many economists have put together. Of course, Ben Bernanke has contributed, and many others, but the contribution of Ricardo and Carmen have been crucial in kind of like starting to put together this picture. And I mean, I don't want to underestimate how important it is for research work to also have like a big picture. What is happening in the world? What is that is really going on, so that we can kind of then focus our research on stuff that is crucial to understand this story. So this is the story. Ricardo's contribution in particular was a seminal paper with Emmanuel and Pierre Olivier on global imbalances. And then later also they updated their analysis to kind of bring the kind of liquidity trap aspect of it when interest rates reach zero, and that has implications. Here I just listed a few papers that in many different ways. I chose 3 papers that kind of took very different directions, because I wanted to emphasize how then the type of research that you do can take very different forms, but this kind of research that kind of says the mindset for thinking about the world economy is crucial. I'm just going to mention this paper by Matteo Maggiori. This was Matteo job market paper actually at the time, which is a beautiful model of global intermediation that tries to essentially go after exactly this view by having an explicit model of risk-taking. And the paper also raises some puzzles, so some issues, of course, which, I mean, then future research will have to address. For example, one puzzle that comes out of Maggiori's modeling of global imbalances is that actually when things go bad, because essentially the US is ensuring the rest of the world by providing safety, the US is going to make a transfer to the rest of the world, so we should actually see the dollar depreciate, and of course we know that instead in the crisis the dollar appreciated, so there are important open modeling issues there. Oh, I'm almost done. So the global view, Carmen in several different papers have contributed to the global view. I'm just going to mention here a recent paper with Ken and Ethan Ilseski, and I apologize for misspelling Ethan's last name, but I didn't misspell any of my authors' names, at least. And this is a beautiful paper on exchange rate regimes today, and there, in a sense, is a different take on the view that the rest of the world, to protect themselves from financial crisis, are accumulating safe dollar assets. But the view is that this accumulation of safe dollar assets is taken to have a tool to kind of protect yourself from excess volatility of exchange rates. And that takes me back to a very important other contribution of Carmen with Guillermo, in which they pointed out how much emerging economies dislike fluctuations in exchange rate. Even emerging economies that actually officially have a floating regime, somehow they often do much more to try to prevent big fluctuations in the exchange rate. And I mean, we've seen Argentina just recently acting exactly in the same way. So I have 1 minute left to talk about the future. I'm going to skip this, and I'm just going to talk about this future thing. And so, in a sense, I'm going to only point out one thing. I think one area in which for sure we need more modeling is connecting this class of models to a better understanding of currency fluctuations. And I'm just going to point you to this last two bullets. So in a sense, in the models that we build, in most of the models that we build, when you choose a floating exchange rate regime, what you're doing is just you're relaxing a constraint. You have a variable there that is the nominal exchange rate, and you're doing optimal policy, so you have a bunch of things that you can do. Suddenly, that variable, you can move it, and you can move it the way you like. I mean, the problem is like the way we describe policy in optimal policy models, like in theoretical models that we use for optimal policy, suddenly you have an extra instrument. So it's always a good thing. And somehow, in reality, that's not really how it works. When you go from a fixed exchange rate regime to a floating exchange rate regime, suddenly you have this crazy financial markets moving your currency around. And the truth is that, so moving to a flexible exchange rate regime is not so much as freeing an instrument, but is kind of like opening up some floodgates of speculative movements and exposing yourself to an additional source of volatility, basically, that wasn't there. And the truth is that in modeling this, we're still not there, and because it's a hard thing to do. But I think that there is probably very important things hidden there, and in particular, like capturing better the fear of floating would require something like that. And I'm gonna be done. So we're done for the day.
Okay, I think what we should do, we have about 10 minutes, maybe a little less. So I think, let me just turn to the questions. Yeah. Yeah. Jose.
These two talks discussed a lot net flows. Now, I think Hume Shin and others have emphasized the fact that there were a lot of the gross flows were much larger than the net flows. And in particular, the gross flows establish a big imbalance with respect to maturity. So the US was in fact borrowing long-term, that is selling assets which were relatively long-term, but also lending short-term. And that's how money markets, a lot of money markets were buying commercial paper. So What does that have with this? How can that happen in this kind of universes we discuss here?
Well, let's collect the questions. Guillermo.
I've been part of this gang and working on these topics for a long time. I wasn't going to ask a question and hear the others and continue learning. So thank you very much for the opportunity of being here. No, I thought that I guess there is a tendency now to sort of think of the emerging markets as if they are subject to an original sin. We continue thinking about them as something that will run into trouble, and what we learn from the past is going to be applicable in the future. Now, when you look around these days, for example, you look at Israel, that had very high rates of inflation in the 80s, and now they have a hard time reaching a 2% rate of inflation. When you go to Latin America, some things are really very impressive, what's been happening. There was a huge terms of trade deterioration because of the end of the commodity supercycle. And some of the countries, Chile is always doing things okay, but others that in the past would not dare to let the exchange rate go, they did, like Colombia, and you see very little pass-through. So all of a sudden we have situations like that that at least make me think. Even Brazil, that had all kinds of problems. I'm looking at Brazil, you have relatively high debt for Carmen's standards. It's about 80% of official debt. The fiscal deficit is 9%, and they have a rate of inflation of less than 4%, while Argentina, which is next door, is 25, whatever, and inflation and the interest rate is over 30. So I wonder if these experiences are teaching us something, and that's all.
Okay. I think we'll let the authors sum up. So
Carmen, do you want to start?
A comment on net versus gross. I think both are extremely important. I think the data on gross flows is definitely of more modern vintage. I think you want gross also to know about the issue of surveillance and rollover risks. But the longer view on net flows is that is very often connected to real resource transfers and also the enabler often for the domestic banking industry to, borrow abroad and lend domestically. On Guillermo's comment, juxtaposing the situation in Brazil and Argentina. Argentina is still, this is we could go on for this, but we don't have the time. But so one very brief. So Argentina is still relying on seigniorage from the central bank in a way that Brazil has stopped doing for some time. And part of the outgrowth is that the loss of seigniorage turns into, because you lose a tax revenue but not replace it with something else, it's the outcome has been the high level of public debt that you allude to. So I think it's importantly connected to financing.
Let me start in reverse. Let me remind you that Argentina is a frontier market. It's not an emerging market anymore. And the introduction of my background notes is exactly says what you just said. It says, look, emerging markets have come a long way since you know, the things that you and I grew up with, and that's the reason I'm going to focus much more on this financial issue, which is a more modern part of the problem. But that doesn't mean that there aren't countries out there that still have the old problems, like Argentina. But I think the type of crisis we began to see in the 90s and so on were a little different from the past. And part of the global phenomenon we have is a result of that additional prudence, in fact. And so I'm with you, but that creates other sort of problems. To Jose's point, well, our models actually, I didn't talk about this, but except for the models that have no risk, all the models with risk have gross flows. And I didn't talk about the work with ALP on taxation of capital flows and so on. That's all about gross flows. And you're absolutely right. That's a pretty central part of the story. And in fact, in the little mention I made to one of the papers with Arvin is all about precisely sort of this literature of the insurer of last resort and so on is necessarily about gross flows. No? Take safe assets, sell your safe assets, and buy risky assets. What a safe asset means and what a risky asset means changes, and different instruments can create different fragilities. Let me just say very quickly things about our discussions. Helene, on the need to model more the boom phase. Well, we tried. We weren't very persuasive, but the papers with Arvin, really the contribution of that paper to me is more about the ex-ante phase, and why is it that these booms are excessive, given that you're likely to face a financial constraint, and you're absolutely right that the reason for that was a peculiar externality. In the recent work with Alp Simpson, their concern is an aggregate demand externality, but it's also about an excessive boom, spreads compressed too much because the optimists are driving the show, and then things turn around quite dramatically. And the last point I wanted to make is an idea that Guido mentioned, the idea that you go from a fix to a flex, and then suddenly, rather than getting sort of an extra degree of freedom, you get sort of lots of volatility and stuff like that. And I think this is very natural in most with speculation, actually. You complete a market. That happens again in the paper with Alf, not with exchange rate, but you complete a market, and people start betting on that market. And now you have the heterogeneous belief, and that can lead to lots of fluctuations.
Great. Well,
can just one
okay,
tiny...
Sure, go on.
I wanted to thank... I lost my track of in the response. I wanted to thank both of my discussants. And the only thing that I disagree with Guido is flagging the emerging markets as the capital flight issue as an emerging market issue. It's much broader than that. Target 2 balances in periphery Europe are huge. And target 2 balances are nothing other than reserve losses, and a big chunk of it is a capital flight story.
Okay, so a long day. Thank you.